welcome back to this week's market update. Today is October 20th, Friday morning here, 2023, and we had a very exciting week, so let's jump right in. This week came with retail sales figures as well as residential real estate data and a 10-month low in weekly initial claims data alongside geopolitical developments elsewhere. By market's close on Thursday, October 19th, we saw the Dow Jones Industrial Average close 1.7% lower, the S&P 500 close about 2.2% lower, and the Nasdaq Composite down about 2.8% lower for the week. Into our data of the week, we got quite a lot, so we'll get started here with retail sales numbers coming in twice as much as expected at 0.7% of an increase compared to a month ago, and this was a 3.8% increase from a year ago. So over 700 billion, no light figure there by any means, and it came in much hotter than expected as well. So here you can see kind of what's driving that. Here's the general retail sales figures, and we had quite a strong month for auto purchases here and a slightly weaker month for general merchandise, but still strong growth in all categories there. Outside of that, we saw non-store retailers experience an 8.4% increase compared to a year ago, while food services and drinking establishments saw a 9.2% increase compared to a year ago as well. So we're really seeing the consumer is continuing to spend, maintaining their spending even in the midst of more reliance on that revolving credit that we've looked at before and declining savings rate. So really interesting stuff here as we take note of where the consumer is at. We also got the housing permit starts and completions data for the month of September here. So you can see here permits coming in at 1.47 million. This was 7.2% lower than it was a year ago. So quite weak on that front, as well as housing starts, which were also down 7.2% from a year ago. On the other hand, we saw housing completions actually up 1% compared to a year ago, and this makes sense because housing permits and starts were stronger a year ago, so obviously those homes are going to need to be completed. So we saw that an increase compared to a year ago. Overall, we're still seeing the story that the lack of new properties, as well as higher prices and 30-year mortgage rates hitting those 8% rates on average, are really posing a lot of challenges for home buyers, especially given that home prices have not gone down at all yet. So really interesting here on the new real estate front, but we'll continue to watch it closely. Also this week, in terms of real estate, we got the existing home sales data for the month of September as well. So not only did we get some new home data as well as this existing home data. So here you can see it was 3.96 million in the month of September. This was down 2% from August, and it was actually down 15.4% from a year ago. So again, a lot of decreased volume in the existing housing market as well as the new housing market, and we're seeing home prices still continue to go up as financing costs go up as well. So here you can see that median sales price is actually up still almost 3% compared to a year ago, despite the higher rates and the lack of volume moving through the market. So housing market looks to be pretty slow, sluggish, as housing prices stay pretty stable, increasing still on a year-over-year basis, and volume is down significantly, as we can see here. So really interesting stuff. We will continue to look closely at this real estate data as it comes out. Shifting gears a little bit towards wider economic conditions, here we got the leading economic index for the month of September this week as well, and that fell by 0.7% in September, following a 0.5% drop in August. Here you can see we've been in negative territory since actually April of 2022, which is quite a recessionary indicator. The main contributors to this decline in September included average consumer expectations for business conditions, the ISM index of new orders, the 10-year Treasury less the Fed funds rate spread, and the leading credit index. So a lot of negatives on those factors that they track alongside to make this index. And we'll see here where we end up if we end up in a recession, if it is accurate, like it has been pretty accurate here. You can see it fell negative right before the financial crisis, fell negative right before the early 2000s tech bubble, and it actually even fell negative right before the COVID mini recession there. So typically is pretty accurate, We'll just have to keep tracking alongside this and alongside our economic data to see if it is accurate in this cycle. But yeah, not great signs when we're looking at leading indicators, especially from this index. So, despite a lot of bearishness from the leading indicators like the LEI that we just looked at, the job market is still pretty robust with the September unemployment rate at 3.7% and weekly initial filings falling below 200,000 for the first time since January. So, here you can see the week ending October 14th. The initial claims data came in at 198,000 claims, which is incredibly low. And like you can see here, it's the lowest point since January this year. So a 10-month low there. Historically, leading up to a recession, the job market typically is pretty strong, and we'll get into that in the next slide. But it's still important to note that we are seeing a strong labor market as of right now. But historically, like I was just saying, leading up to a recession, initial claims typically start pretty low before a recession. So here you can see the gray bars are a recession. We'll have a dip in initial claims, really strong job market, and then a huge spike up in this recession. A dip here, then a huge spike up. But here where we are now, this is actually 2015 here where this chart ends. But in the level that we're at now is right here below 200,000 of last week's claims. And here you can see that's a lot lower than what it typically is in kind of the 250,000 to 350,000 claims right before it shoots up in a recession. So really interesting stuff as we look at the labor market and see where it might end up next. Overall, definitely a very dynamic week with a lot of mixed signals on consumers, real estate, and the job market. So we really appreciate you tuning in, and we look forward to providing more updates next week.